How is China coping with the economic downturn? Well, here to tell us the answer to that question is Kobus van der Wath. He is the founder and the group managing director of the Beijing Axis. Thank you for being with us on INSEAD Knowledge.
Good to be here, Shelley.
All right, so how is China coping with the economic downturn?
Yes, well, the story in China is somewhat different from what we're seeing in the headlines globally. I think the headlines globally are dominated by what's happening in the US, Western Europe, Japan. China, very different. We've seen the lofty levels of growth of 10%, 11, 12%, even higher over the last few years. And policy has been tightened over the last few years with an interruption to that immediately after the global financial crisis, because it was also important there not to slow China too much.
The tightening, for example, letting the yuan not float, but raising interest rates to change.
Yes, certainly it's allowed the government here to let the renminbi become significantly firmer. We've certainly seen fiscal policy tightened. We've certainly seen monetary policy more broadly tightened in terms of statutory reserve requirements, interest rates, and moral suasion to get bank lending to be slowed down and for the general liquidity environment to be a little bit slowed down. Now that then continued, this tightening continued as the rest of the world with China started to look a little bit safer by, say, the middle of 2009. And then throughout 2010 and into 2011, this tightening continued. It has now resulted in the first half of 2011 it resulted in growth of around 9.5%, 9.6 and 9.5% growth roughly in the first and second quarter. So as we sit here in the third quarter of the year, the economy is growing at just below that and will probably be growing at around 9% by the end of the fourth quarter for a full year rate of growth for 2011 of just over 9%, perhaps say 9.2, 9.3%. Now, that means that it's very different from just about anywhere in the rest of the world. India, of course, is doing very well. Indonesia is still doing well, and certain other parts, even Africa. But the West, very soft. So in that general sense, China is slowing, but still doing well, and there's no hard landing. Specifically, I think what we've been looking at is inflation. Inflation started to rear its head over the last year. Coming into 2011, we saw inflation edge higher and has recently been at 6.5%. So we see this GDP growth slow down, but also inflation peaking at about the 6.5% level. And some of the sub-indices in the inflation environment also having been important areas such as food prices, energy, and so on. So that generally means that policy having been tightened over the last few years as the global crisis eased, it has worked. China is slowing and is perhaps seeing growth fall to a level that is more sustainable and that is desirable. So we don't see a hard landing in the making here. So for next year, we're looking, for example, for growth of around 8, perhaps a little closer to 8.5%. And then I think 2013, 14, and 15 will be the real challenge. China will face some of its toughest policy challenges, ever. And I think that's the interesting horizon to look at.
What will that be? I mean, are you talking about in terms of just the debt issues that are going on in the industrial world and in the U.S. and in?
Well, there's a lot of uncertainty about what will happen in the U.S. and the developed world, of course. At least in the very short term, we think it will be more of the same. But that far out, we don't know how bad things could get in the rest of the world. Now, as it stands already, China is no longer deriving growth from net exports. If we see China looking at a more sustainable structure of the economy, it also can't continue to rely on the super projects and the pump priming, which means that its fixed asset investment as a lever for growth no longer exists. Which means there's really this need, and it's also an objective, it's also a goal, but there's the real need for China to find growth from the people, from domestic demand, and specifically from personal consumption.
Looking at the sustainable, larger global growth scenario, China's been one of the biggest buyers of U.S. debt, U.S. T-bills, and everything else. They're beginning to lose their appetite for it a little bit. How do they see their responsibility as part of the world player? Because, I mean, if the rest of the world continues on a downward slope, it's, as you've just pointed out, it's not going to help China. Will they continue, even with rates as low as they are, for long-term investments? Will they back Europe? I mean, what's their stance?
It's a good question, and I think very important or very high up in the list of considerations is this question of what are the alternatives. If you're a $3 trillion, $3.5 trillion reserves country, how do you manage that? What is the asset allocation? And we've certainly seen the sovereign wealth fund being capitalized out of that. We've certainly seen the idea of investing in fixed asset, physical mines and so on, infrastructure in developing regions of the world. But, you know, managing such a large and vast global portfolio still means you're dependent on foreign exchange, you know, hard currency. And the US dollar is still so important. You also have the euro, you know, where there are real question marks about what the euro region area will look like going forward. It's very interesting. Even just in the last day, we've seen the Swiss, you know, peg their exchange rate, which was interesting news overnight. So this global landscape that central banks around the world find themselves in managing foreign exchange reserves, and with gold performing the way it has, presents a whole new challenge for countries everywhere. China, however, is the only country with such a large portfolio to manage, and there are simply not enough alternatives. So I think there will be a slow and steady rebalancing of that exposure, and perhaps, as you put it earlier on, there will be a more cautious approach to US, you know, bills, notes, and bonds. But China cannot simply step back from it en masse. It understands the linkages. It understands the risk premium, the cost of capital, the knock-on effect, you know, the potential impact on global confidence and the ripple effect through its other trading partners, countries that invest in it, countries that it invests in. So I think China is acting, if anything, more and more responsible and at least very aware of the global linkages.
People call it government capitalism. It's everything, but it's still a communist system. How would you define it? Because they certainly are acting like capitalists.
Yeah, well, look, you know, I've now spent a relatively long time in China, and I hear people's comments, and I also observe myself. I think we need to separate what the political system is doing and has done, and how that is evolving, and how the economic system. Now, there's of course a big connect between the two, and that's what makes it difficult to form clear views that are succinct and clear. But putting the political system and evolution there aside for the moment, we've seen a very strong move towards marketization. If we think back in 1980, coming from, you know, the open door policy, you know, under Deng Xiaoping, late 1970s, you know, the price setting, lack of property rights, private ownership, to where we are today. You know, I remember friends of mine in China not having a credit card or a debit card, not owning a home, not owning a car, no leverage in these societies, different communities. So we've moved to, you know, relatively free movement of you know, ownership principles, fixed ownership, fixed asset ownership, and even intellectual property. You know, there's all this talk and still frustration around intellectual property rights in China, but even there, we're starting to see Chinese companies sue one another over intellectual property rights. So that change of what is at the core of communism, you know, in terms of a basic definition, property rights or the lack of it, that has now become entrenched in China. And price setting, which is one of the basic goals and functions of markets, you know, in supply and demand, that is starting to do its job more and more day by day in most industries, regions, segments of Chinese life, Chinese society at large. There are still some industries and some parts of value chains, transaction chains, where there's a rigidness or a lack of free price movement and price setting. But the change overall, I think, is irreversible. That then means that today we're not really dealing with a communist system in the broad sense when we think of 70s, 80s in different parts of the world, in fact. We're dealing with China the way it is today. And It's still an evolution. It will still change a lot more in the years to come.